Well, I think if we look at the macroeconomic environment, the inflation is and currency devaluation is the number one issue. And I will give you an interesting statistic, Guy. Do you know that Zillow thinks that my house is 305 times more valuable than it was in 1930? So a lot of times, if you go look at Bureau of Labor trade statistics, they'll tell you that the dollar's lost 95% of its value over the last 80 years. But that's actually not true. The dollar's lost 99.7% of its value if your benchmark was Miami Beach real estate or any scarce desirable asset. I bet the story's not that different for New York City or Hamptons real estate or Picasso's or the like. So inflation's an issue, and I figure the CPI is 8%, but the real inflation rate in assets is 15 to 20%. We know that all these currencies are weakening, right? Every Eastern European currency is weakening. The yen is weakening against the dollar. I mean, everybody is weakening, and the dollar is losing 20% of its value. So I think the macro environment says I got to find an inflation hedge. The political environment, on one hand, is a massive endorsement for digital assets by the White House last week when President Biden said 40 million Americans need digital assets, and we're going to embrace this. And I think a massive advertisement for Bitcoin with the Ukrainian-Russian war, and especially the sanctions, where we seize $300 billion worth of treasury assets from the Russians. I think the Chinese have $3 trillion worth of assets, and that might have got their attention. And probably pretty much the conclusion is, if you're any nation state in the world and you think you might ever be in conflict with another nation state, and you're holding their credit derivatives or their currency derivatives or their currency or gold in one of their banks, that's not really proper anymore. So I think that's got everybody scratching their head saying, I don't trust the currency as a long-term store of value, A, and I don't trust my assets to not be seized, B, what am I going to do? And then right in the middle of that, you see things like Bitcoin poking their head up saying, hey, check me out. Capital gets attracted into commodity production. It's a feedback. People produce more. Gold price comes down. People keep producing to try to recover their cash flows. Lots of intelligent people become desperate. What if you put it in the largest bank in Japan, in Tokyo, in 1900? Name a city you could have, and a bank you could have put it in 1900 that would still be there in the year 2000. It's a short list, by the way.
Yeah. London,
Switzerland, Zurich, New York. You would have failed in Paris, Berlin, anywhere in Eastern Europe. You would have failed in Moscow. You would have lost it all in Beijing. You would have lost it in Tokyo. You would have lost it all anywhere south of the Rio Grande.
Yeah. And in the
U.S.
lost
it everywhere in Africa.
Possibly would Executive Order 6102 have impacted you in the U.S.?
And you would have lost it in the U.S.
Yeah.
Okay. Isn't it ironic? Okay. So can't we reduce it down to maybe Switzerland? Maybe.
Yeah.
Like it's an interesting exercise for the reader, but the counterparty risk on gold is at the municipal level, the state level, the federal level, and the corporate level. And that's and over there's a phrase, right? Over a long enough timeline, the mortality rate is 100%.
In the long run, we're all dead, right? Sort of. I think Keynes may have said that.
He said it. Robert Heinlein wrote a book called Lifeline, and he said, over a long enough timeline, the mortality rate is 100%. In this particular case, back to our gold network. we have a gold network, and we want to move money. So I put $100 million in gold, and I want to move it around. Well, it's 25 basis points every time I move it around the world. If I move it once a quarter, it's 1%.
Now that you're seeing our central bank, our Federal Reserve, and other central banks try to stem the tide, is it too late? Is the genie out of the bottle in terms of fiat currencies?
Yeah, I mean, I don't think anybody wants a strong currency. I think that the U.S. is weakening their currency. the yield curve is dead flat, Guy. It was like 240 basis points for 1 or 2 year money and 240 basis points for 30-year money. And the irony is, in the face of that, where you've got 8% CPI, probably you've got 10 to 15% PPI, you've got 15 to 20% asset inflation, you've got a 2% long-term interest rate. In the face of that, you've got the Japanese holding 10-year money at 25 basis points, exercising yield curve controls, saying they will literally buy infinite bonds to hold the interest rate at 25 basis points. And the result is, lo and behold, surprise, surprise, the yen is weakening against the dollar. And then, of course, the mainstream media narrative is this is really great for Japanese manufacturers. It's not a problem. There's no inflation. And you look at it and you say, well, it's pretty hopeless. You've got like, I would say $100 trillion of currency, $100 trillion of currency derivatives in the form of sovereign debt, and another $100 trillion worth of equities and commercial real estate that are value based on fiat cash flows. So that's $300 trillion worth of assets with a negative real yield of anywhere from minus 15% to minus 20% properly understood. Improperly understood, the negative real yield is only minus 6 to 8%, right? So that's your situation. If you're a rational investor, you have to stampede to property. And now the debate is just what's the most desirable property? Is it land? Is it art? Is it sports teams? Is it gold? Is it Bitcoin? Is it some other crypto? You know, have you invented cold fusion, you know, in the next Tesla? And are you going to buy that? And so that's the investor attitude. I don't see there's no political conviction or will or any likelihood that we're going to stop the expansion of the money supply. I mean, no one's expecting that. No one's even talking about that. So that being the case, I think your real choice is just, do you want to be long property? Which property? And of course, my attitude would be you should be leveraged long property in an inflationary environment. You want to be short the dollar. By the way, you want to be short the dollar because it's like negative 15% real yield, but I'd even more like to be short the peso, which is probably a negative 35% real yield. So you want to be short a weak fiat currency via debt. And then you want to be long a property, ideally a non-sovereign store of value. Or if you're going to hold property in a nation, hopefully you either own the country or you trust the country. How valuable is $1 billion of real estate in Moscow right now, right, to anybody in the Western European region?